Tesla is scheduled to report quarterly financial results when the markets close on October 23rd, and investors are asking if they should buy Tesla stock before the company announces those quarterly earnings results. I'll answer that question in this video. I'll also provide a preview for what Tesla stock investors should expect from the company in the upcoming earnings release, the key numbers to look for, the key qualitative factors to look out for, and what would make a good earning release versus what would make a bad earnings release for Tesla when the company reports its quarterly financial results. So let's take a look at the details. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So one thing we already know about Tesla's third quarter is the production and delivery numbers. I guess that's two things we already know. The company reported how many vehicles it produced and how many it delivered in the latest quarter, saying that it produced 469,796 vehicles and delivered 462,890. The delivery numbers are almost equivalent to sales numbers because the cars need to be sold before they are delivered. So it's a proxy for sales for Tesla in the latest quarter. It delivered about 7,000 fewer than it produced. So inventories are likely to have increased in the quarter. The company also reported that gigawatt energy storage products improved as well. Tesla, that's one of the areas it wants investors to focus on more. Basically, Tesla's been pointing to everything else other than car production and delivery numbers because these numbers have not been great. So Tesla's been talking about energy, talking about artificial intelligence, robotics, basically anything other than electric vehicle sales because those have been disappointing. Now, the company's total revenues in the latest quarter were just up by 2%, only 2% increase to $25.5 billion. And that's the result of total automotive revenues being down 7%. So car sales, which is by far the largest part of Tesla's business, you can see out of $25.5 billion in revenue, $19.9 billion came from car sales. So that's why I keep suggesting that this is a car business. The vast majority of the company's sales come from cars. And so, yes, maybe at some point in the future, this will not be the case. But for now, this is the case. And until Tesla shifts the percentage of the business to something outside of car sales, I'll keep evaluating the company as a car company, and then I'll shift as the company produces and demonstrates a reason to value it differently. I'm not just going to take the word of a company's management and value the company the way the company's management wants me to value a company. Of course, they want me to value the company like an AI and robotics company. I'll share with you why that's the case right now. So right now, Tesla is trading at a forward price to earnings of 69.93, a very expensive valuation. You compare that with a couple of its car company rivals, Ford and GM, they're trading at forward price to earnings of 5.8 and 5. So of course, Tesla doesn't want you to evaluate it as a car company because that would mean the valuation needs to be 1/10 of where it is today. So of course, they are incentivized to get you to focus on it in a different light because that gives it a higher valuation. But even if you look at it like an AI company, it's still very expensive compared to Microsoft and NVIDIA, which are two AI tech companies, right? NVIDIA is trading at a forward price to earnings of 34, and Microsoft is at a forward price to earnings of 27. So even if you compare it to AI companies, Tesla is more than twice as expensive as those other AI companies. But that being said, you can see the operating profit margins of AI companies. NVIDIA's profit margin, 62%. Microsoft's profit margin, 44%. Do you see Tesla here? You do not. You see Tesla's profit margins where the car companies are, like Ford and GM, in the single digits, 7.5% for Tesla, 6.5% for GM, and 2.21% for Ford. This is why car companies are unattractive. This is why, for several years now, I've told investors to avoid EV stocks. It's not an attractive business to be in, even at larger scale. the business does not generate strong profit margins. And that's precisely why Tesla wants you to think of it as an AI company before it even approaches anywhere near the profit margins of an AI company. It's promising you that at some point in the future, it will do that, right? So looking at its operating profit margin trend, that's not good either. 6.3% in the latest quarter, down 333 basis points year over year. Now, when the company reports the next quarterly results, the one that's upcoming here, I expect the operating profit margin might improve, especially if the company was able to grow the energy storage and services side of the business at these excellent rates of growth. The energy storage business increased by 100% in the latest quarter. If that trend continues, that could lift the company's profit margin in the near term because EV sales, those are not doing well, as I highlighted earlier. The company's offering lower prices and more attractive financing terms to get these sales through. And so I wouldn't be surprised if vehicle margins are flat or down in the quarter, but the energy and services side of the business might help facilitate an increase in operating profit margin. Nevertheless, the improvement should not be anything significant. I expect the company's profit margins to continue to remain very, very low for a very long time while it builds out this driverless car business, while it hopefully introduces a lower priced model. That's the thing I'm going to talk about a little bit later. Net income also not going in the right direction, minus 45% in the latest quarter to 1.5 billion. But I think operating profit margin is the more informative number to look at with Tesla compared to net income, and that one was not as bad as net income. Thankfully, the company has an excellent balance sheet, and I see that too persisting as well. It has $30 billion in cash and very little debt, especially compared with other car companies. Tesla's debt is way lower than any other car company, so that it has working for it. And even though I've highlighted that Tesla is overvalued compared to other car companies, I still think Tesla deserves a premium valuation compared to other car companies. It's one of the best car companies in the world. The problem is that it's trading at one of the best. It's trading at a valuation like 10, I showed you 10 times that of every other car company and more than 2 times that of large AI companies. So even in that case, I think the premium is very, very high for this. All right, so I want to hear more when the company reports about the Cybertruck. They highlighted that production more than tripled sequentially and remains on track to achieve profitability by the end of this year. That would be really good. I want to hear more about that. Are they still on track to reach profitability for the Cybertruck? And is the goal still to hit 250,000 units of Cybertruck sales? Is that still possible? Or is the initial release so disappointing that the expectations need to be downgraded? That will be something that I really want to hear about from Tesla, because that can be something that generates some growth, because you saw the car sales down 7% year over year. So if the Cybertruck can scale up, it can help grow the business, grow that side of the business. Otherwise, it's going to be very difficult going for Tesla. Competition is increasing and intensifying, and Tesla doesn't really give buyers a reason to go into one of their models, especially the older models that haven't been changed in so long. Competition is coming out with newer, more exciting models, lowering the prices, and so consumers going out there, they have more choice and they're choosing other cars, and that's been working against Tesla. So the services business is likely to perform well, and in an effort to increase EV penetration, Tesla continues to open its network to non-Tesla EVs and partner with more manufacturers to give them access to Tesla charging stations. So while this will increase their network utilization, it's going to upset some Tesla car owners that now have to share the network with all other car buyers, right? Initially, Tesla car buyers were sold on the idea that they get access to this special Tesla charging network, and now they have to share the network with all other EVs. Pretty much that's the plan for Tesla. So again, Tesla car buyers were told one thing and now have to accept another thing. Not much unlike Tesla investors who are often told one thing and have to accept another thing. That's just Tesla's way of doing things. They overpromise and underdeliver. So here's a key thing. Plans for new vehicles. The lower priced model is critical. I know Tesla doesn't like to talk about it because it's years and years behind schedule and prices are going to be higher than they expected. But the lower priced models are absolutely essential for this business. The talk of the robo-taxi is good for inflating the stock price, but for the actual business, sales and revenue and cash flow, they need that lower priced model. So plans for new vehicles, including more affordable models, remain on track for production in the first half of 2025. This is the critical thing. This is the big qualitative thing I'm looking for from Tesla in this upcoming earnings release. Are they going to talk more about precisely when this lower priced model is going to come out? Now, they say that it'll utilize some aspects of the next gen platform as well as some of the current gen platform, and it'll be on the current manufacturing line. This will result in achieving less cost reduction than previously planned. Again, another data point where Tesla told investors many years ago that they're going to produce a $25,000 model. And now that the date is approaching, they're now saying that it's going to be not that low. It's not going to be that. We're not going to achieve as much cost reduction as we told you, right? So yet another data point, overpromise, underdeliver. The company's in the habit of doing that. So should investors buy the stock ahead of earnings? I say no. The stock is overvalued, as I shared with you. If you're intent, if you're like absolutely convinced that you want to buy Tesla stock, at the very least, wait until after the earnings come out. That way you do reduce the risk of any downside coming out of the earnings release, and you get the company at the most point of information. The point in time when you have the most information about the company is right after they release earnings. So at least you'll have that going for you. And if you still want to overpay for this stock, by all means, go ahead and do so. But at least to reduce your risk, do it after earnings. By the way, for full transparency, in case you didn't already get this from my tone, I feel Tesla stock is overvalued and I am short this stock. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.